time to get you a special voice today on the show, and we're going to talk about moat investing. It's an investing form that's come a long way since the first time it was coined by Warren Buffett in the 90s, and hundreds of money managers swear by the method, in fact here in India as well. At the CFA India conference today, Ajay Sharma caught up with Morningstar Australia CEO Heather Brilliant, who's quite the expert on moat investing, and spoke about its relevance, especially in the Indian context.
There's a lot of different ways to look for companies with moats. We start by looking for one of 5 sources. We look for companies with intangible assets, with a network effect, with a cost advantage, or that have the ability to kind of operate within a more defined market, what we call efficient scale. And switching costs is the last one. So we really look for companies that fundamentally benefit from one or more of those sources.
So I'm not sure how closely you actually look at Indian markets, but which are a couple of companies which you can talk to us as examples which have very strong moats around them?
Yep. So among the companies that we cover in India, we find Dr. Reddy and Infosys as 2 examples of companies with really strong narrow moats that we think have built very sustainable businesses.
So when fund managers over here in India and asset managers go about identifying these moats, what are the things they should keep in mind so that they can pinpoint such companies which have strong moats?
Well, when you're kind of entering a new market or looking at the Indian market broadly, it might be good to look for companies that have high returns on equity or high margins, or something that could be evidence of a possible moat, and that kind of helps with the screening process, because otherwise it's very overwhelming to analyze every company in a market. So we use screens to try to get a better idea quantitatively of which companies to dig into in more detail.
So how do you think returns in successful implementation of moat investing can be relatively much more than people who purely go about looking at the different ratios, etc., and business models when they analyze? How can this be much more rewarding?
I think one of the most important benefits of using moats in your investment process is that you're really taking a different time horizon. You know, we look at a company's competitive advantage over 10 to 20-year periods, and so you're really looking at that long-term competitive advantage. The other thing I'd say is that finding companies with moats is not enough. It's necessary but insufficient. You also need to look at valuation. And so, you know, buying companies that are very from a competitive advantage standpoint when they're cheap is what we think is the key to success.
So correction time is actually the best time to, so you can identify moats and then keep waiting when the low tide comes in, then you actually dive in, right?
Exactly, that's the best way.
Okay, talk to us about what exactly are specific moats. Is technology a moat? What are the other things, or management quality is a moat? What are the other things which are good examples of moat in any company?
So actually I wouldn't put either of those alone as enough to demonstrate a moat. I think you know, if you're thinking about intangible assets, you could see a benefit from a really strong management team, but unless you can really see that coming through in the structural business itself, we wouldn't consider management as sufficient to form an economic moat. We'd really be looking for things like a brand that compels consumers to pay more, or maybe a government regulation that protects a company's ability to charge a certain price. You know, branded pharmaceutical companies would be an example of that.
Globally, when you were conducting this research, which are the companies which you may have backtested that at one point in time were much smaller size, but because they had strong moats around them and they were picked up by reputed fund managers, over a period of time they became very huge companies and the returns obviously were much bigger? Talk to us about some of the examples from your study.
Well, one example is Facebook. Actually, when Facebook went public, it was still a relatively small company, and there was a lot of skepticism about the IPO. People thought it was overpriced and that it wasn't a good investment, and so it did quite poorly right after the IPO, which was a great opportunity for us to be able to say, actually, this is an amazing network effect, and we think this is a wide mode business. I think IPOs actually can frequently be an opportunity to invest in a business that is perhaps worth more than the market is seeing at the time.
And remember, every market participant worth his or her salt was at that CFA conference, for which ET Now was an exclusive partner. So we rounded up a few more of those sound bites for